Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Reinsurance is insurance for insurers. Reinsurers accept portions of risks underwritten by primary insurers, providing capacity, capital relief, and risk diversification. In African markets, reinsurance is particularly important because primary insurers often lack the balance sheet capacity to retain large commercial and catastrophe risks. The African reinsurance market generates approximately $10 billion in annual premium, with significant growth potential as African economies develop and insurance penetration rises. This presentation examines the African reinsurance landscape, focusing on the multi-billion-dollar institutions that anchor it and the structural forces that will determine its trajectory over the coming decade. The African reinsurance market generates approximately $10 billion in annual premium ceded by African primary insurers to reinsurers. Approximately 40% of this premium is ceded to African-domiciled reinsurers, with the balance going to global reinsurers based in Europe, the United States, and Bermuda. Combined capital of African reinsurers exceeds $8 billion, providing significant capacity for African risks. More than 15 active African reinsurers compete for business, with the largest 5 capturing approximately 70% of the local reinsurance market. The African reinsurance market has grown at approximately 8% annually over the past decade, driven by primary insurance growth and increasing risk awareness. The leading African reinsurers are anchored by Africa Reinsurance Corporation, headquartered in Lagos with a premium volume of approximately $850 million. Africa Re is owned by 36 African governments and the African Development Bank, making it a true Pan-African institution. Continental Reinsurance, also based in Lagos, is the largest private African reinsurer with $350 million in premium. Kenya Reinsurance Corporation (ZEPRE) and Best Re anchor the East and North African markets. GIC Re Africa, Misr Insurance Re, and Wayaka Re round out the major players. Together, these institutions provide the backbone of African reinsurance capacity. Africa Reinsurance Corporation, commonly known as Africa Re, is the largest and most influential African reinsurer. Founded in 1976 by the African Development Bank and 36 African governments, Africa Re operates from its Lagos headquarters with regional offices in Casablanca, Nairobi, Cairo, Abidjan, and Ibin. The company writes approximately $850 million in annual premium, with a diversified book across property, casualty, life, and specialty lines. Africa Re's ownership structure gives it unique access to government and quasi-government insurance programs across the continent, and its capital strength allows it to retain significant risk without recourse to retrocession. The company consistently delivers underwriting profits, with a combined ratio typically below 95%. African reinsurers write 5 core product categories. Proportional treaty reinsurance cedes a fixed percentage of an insurer's book to the reinsurer, sharing premium and losses in the same proportion. Non-proportional treaty or excess of loss covers losses above a defined retention, protecting insurers against accumulation risks. Facultative reinsurance covers individual large risks, typically energy, construction, or aviation, that exceed treaty capacity. Catastrophe reinsurance covers accumulation losses from natural perils, with African catastrophe cover growing rapidly as climate risk awareness rises. And life reinsurance covers mortality, longevity, and morbidity risks, with African life reinsurance growing as life insurance penetration rises. Local and global reinsurers compete head-to-head in African reinsurance. African reinsurers like Africa Re, Continental Re, and Kenya Re benefit from regulatory preferences, with most African markets requiring primary insurers to cede a minimum percentage of risk to local reinsurers. They have deep local market knowledge, strong relationships with primary insurers, and competitive cost structures. Their limitations are smaller balance sheets and limited specialty reinsurance expertise. Global reinsurers like Munich Re, Swiss Re, Hanover Re, and SCOR bring significant balance sheet capacity, sophisticated modeling and analytics, and broad specialty expertise. They compete aggressively for African business, particularly for large commercial and catastrophe risks. Their challenge is building local relationships and navigating heterogeneous regulatory regimes. The two groups increasingly cooperate through quota share arrangements, combining local market access with global capacity. Reinsurance regulation is national, with growing regional coordination. Most African markets require primary insurers to cede a minimum percentage of risk to a national or regional reinsurer, typically ranging from 5 to 20%. Nigeria requires cession of at least 5% to Nigeria Reinsurance Corporation. Kenya requires cession of at least 20% to Kenya Reinsurance Corporation. Shima Francophone West African countries require cession to SICORI. These mandatory cessions are designed to build local reinsurance capacity and reduce foreign exchange outflows, but they can also reduce primary insurer flexibility and increase reinsurance cost. The trend is toward gradual reduction of mandatory cessions as local reinsurers build scale, with regional coordination through the African Insurance Organization and the African Reinsurance Forum. Reinsurers invest premium income and manage capital through 5 key considerations. Conservative investment mix. Reinsurers typically invest in high-quality government bonds, supranational debt, and investment-grade corporate bonds, with limited equity exposure. Capital adequacy. Reinsurers are subject to capital adequacy requirements, often based on Solvency II equivalent frameworks, requiring significant capital against insurance and market risks. Retrocession. Reinsurance for reinsurers allows reinsurers to manage peak exposures and free up capital for new business. Catastrophe bonds. Insurance-linked securities are emerging as alternative capital sources, with African catastrophe bonds a small but growing category. And currency management. Reinsurers face currency exposure across multiple African markets, requiring sophisticated foreign exchange hedging and asset liability management. In the 2023 financial year, leading African reinsurers delivered an average combined ratio of 93.5%, with Africa Re leading at approximately 92%. Average return on equity was 14.2%, with the leveraged nature of reinsurance producing attractive returns when underwriting is disciplined. Combined premium across the top 5 African reinsurers exceeded $1.6 billion United States dollars. Median solvency coverage was 2.3 times the regulatory requirement, providing significant buffer against large losses. The African reinsurance industry has delivered consistent underwriting profits over the past decade, supported by disciplined pricing and conservative reserving. In summary, African reinsurance premiums will grow at mid to high single-digit rates, driven by primary insurance growth and increasing catastrophe exposure awareness. Climate risk and renewable energy projects will be the most significant new product categories over the coming decade. Local reinsurers will continue to gain share through regulatory preferences and growing technical capability, and insurance-linked securities and catastrophe bonds will emerge as alternative capital sources for African catastrophe risk. The reinsurance subsegment offers attractive structural growth with disciplined underwriting profitability, anchored by Africa Re as the Pan-African champion. Thank you for watching this examination of reinsurance.